Hello everyone, this is Brandy Williams with an educational accounting and tax video. Please like, share, and subscribe to my YouTube channel. You may also follow me on Instagram, Facebook, and TikTok at Williams Act Tax. On LinkedIn, connect with me by searching Brandy C. Williams Mac. Lastly, visit my website, williamsacttax.com, to review my bio, read my blog, enroll in tax school, contact me, and schedule a free consultation. I look forward to hearing from you. Enjoy the video.
What to consider when forming a captive. When forming or joining a captive insurance company, there are various factors to consider. Captive insurance companies often allow for more risks to be covered than a traditional insurance company. These risks may be industry-specific. Actuarial analysis of loss claims. The actuarial analysis is an excellent technique to determine whether your company might benefit from a captive. An actuarial analysis is frequently necessary for companies that maintain a significant cash amount of insurance risk, typically through a self-insurance scheme or a high-deductible program. When a business wants to transfer all or a portion of its losses to a captive insurance firm, it might apply the actuarial analysis. In fact, in some circumstances, forming a captive insurance company is motivated by actuarial analysis. A company can assess its unpaid losses associated with its insurance risks using an actuarial analysis. In other words, it enables the company to determine how much cash it needs to set aside to cover claims for which it is already responsible. Premiums, costs, and reinsurance. A captive's primary source of income is premiums. To start, it can be preferable to fund premiums conservatively in order to accumulate enough capital for the captive to handle unforeseen circumstances and pay claims. A sufficient yearly premium and a robust capital position are necessary for managing the expense of claims over the long term and the volatility of losses from year to year. Due to the fact that the parent will often try to prevent big year-over-year premium swings and requests for unforeseen capital infusions when claims greatly exceed the captive's cumulative retained earnings, the premium set is a crucial exercise. In the traditional insurance market, businesses are limited to the coverage, deductibles, and limits provided by insurance carriers according to the one-size-fits-all idea. Sometimes necessary coverage is not available or is too expensive. Companies, on the other hand, may be unable to finance required insurance coverage, deductibles, and limits under a self-insurance arrangement since they lack access to the reinsurance market. A captive has the freedom to customize policies for a particular insured and access the reinsurance market. Product vendors, group and association captive insurers, in particular, have a tendency to rely extensively on outside vendors to offer a wide range of services. However, because many captives don't apply a set of vendor management best practices, these partnerships frequently suffer. Tax advantages. Large companies frequently use captive insurance companies to reduce their insurance costs, and these companies are often established in offshore tax havens. Small, closely owned companies, on the other hand, might enjoy a variety of tax and financial benefits by establishing their own captives. These captives can be formed in the nation-state where the captive's business makes the most sense. Onshore or offshore domicile? One of the most crucial choices in a captive feasibility study is the decision of a captive's domicile, and onshore or offshore is the first crucial dilemma that needs to be resolved. Since all financial and operational assumptions rely on the domicile selection, this issue is so crucial that it must be answered before any other issues can be addressed. Of course, there are several reasons why a prospective captive owner might prefer an offshore domicile to an onshore one. However, one of the principal reasons cited by many captive owners is the significant benefit related to regulatory requirements, which are often significantly less onerous than those of onshore competitors in terms of solvency and initial capitalization. Flexibility, simplicity of entry, established infrastructure, cost reductions, and significant tax advantages are additional benefits. Today, however, onshore domiciles are rapidly expanding and represent a reasonable option for offshore domiciles. The following are some of the reasons mentioned by captive owner. Due to recent changes in international regulations, the majority of domiciles may no longer be regarded as offshore tax havens. Tax differences are also less significant. Numerous onshore domiciles are evolving to be equally flexible and creative. The expense of running an offshore captive is rising, both in terms of money and time. Operating a captive. Reinsurer risk sharing. The captive will probably act as a reinsurer for the risk-sharing partner, taking on a specific amount of risk and accompanying premiums. The captive is currently operating as a reinsurance firm. It will probably also buy reinsurance on its own. It is in the best interest of the owners to form the proper committees, such as audits, claims, investment, and underwriting. TP as services providers. If claims are not handled in-house, TPAS will frequently be called in. If so, a claims committee will be in charge of analyzing claims reports on a regular basis in order to identify trends, underwriting violations, and reserving procedures. It might also be involved in choosing adjusters, choosing attorneys if needed, and managing reserves. Investment managers, CFCs. A captive may be regarded as a controlled foreign corporation CE. If us stockholders own it entirely or in part, a CFC is a corporation that is based outside of the U.S., has 50% or more shareholders, and each shareholder owns at least 10 of the business. Offshore captives with us shareholders are typically classified as CFCs. Captive agent. A captive insurance agent offers protection from just one insurer. A captive agent may operate their own local agency and work as an independent contractor or as an employee. A captive agent agrees to market insurance products from just one insurance company and maybe its partners. When examining an agent's website, it's unlikely that you'll come across the phrase captive agent, though. They may be called local agents or agency owners in popular usage. Typically, captives are created with risk management in mind. Comparing premiums paid to commercial insurers with those paid to captives, a business can significantly reduce insurance expenses. The captive can also offer coverage that is insufficient or unavailable in the open market, in addition to the chance to get more specific insurance for the risks faced by companies. The parent company can have more control over claims decisions.
This is Brandy Williams. I hope you enjoyed the video. Please like, share, and subscribe to the channel, and follow us on all social media platforms.